Hello and welcome back to Money Never Sleeps. My name is Dilip John from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at manwealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. If you have a traditional IRA, you've probably spent a good amount of time thinking about how to build it up. Contributions, investment choices, compound growth over time. But there's another side to that conversation that doesn't always get as much attention, and that's how and when you actually take the money out. Because it turns out that the decisions you make about withdrawals can matter just as much as the decisions you made while you were saving. The timing, the amounts, the sequence, all of it has the potential to affect your tax bill, your Medicare premiums, your Social Security benefits, and ultimately how far your savings go. Today, I'm pulling from a U.S. News and World Report article titled 7 Things to Know About Withdrawing Money from a Traditional IRA. Let's go through the key points one at a time. The first thing to understand is that withdrawing too early comes with a cost. The government imposes a 10% tax penalty on money withdrawn from a traditional IRA before age 59 and a half, and that penalty is on top of the ordinary income taxes you already owe on the withdrawal. For someone in the 12% tax bracket, taking an early withdrawal could mean losing close to a quarter of the amount between the penalty and taxes owed. That's a significant hit on money that was supposed to be growing for retirement. That said, it's worth knowing that there are specific circumstances where the 10% penalty doesn't apply. A first-time home purchase of up to $10,000 is one of the more commonly used exceptions. Others include a permanent disability that leaves you unable to work, a terminal illness diagnosis, unreimbursed medical expenses above a certain threshold, higher education expenses, health insurance premiums during a period of unemployment, and qualified birth or adoption expenses up to $5,000. In all these cases, the penalty is waived, but income taxes still apply. The IRS also allows substantially equal periodic payments under Rule 72T before age 59 and a half, though once you set that schedule, you generally can't change it until you're 59 and a half or 5 years have passed, whichever is longer. The flip side of withdrawing too early is waiting too long. Everything that comes out of a traditional IRA is 100% taxable as ordinary income, so ideally, you want to time your withdrawals for lower income years, when you're in a lower tax bracket. For many people, the early years of retirement represent exactly that window. Your income may have dropped, you're not yet drawing Social Security, and there's an opportunity to take distributions at a lower rate than you might face later. That window is also when Roth conversions can make sense for some people. A Roth conversion means taking money out of your traditional IRA, paying taxes on it now, and moving it into a Roth IRA where it can grow tax-free and future qualified withdrawals may come out tax-free. The article cites ages 55 to 65 as a sweet spot. Because children may be grown, there's potentially more flexibility in the budget to cover the tax on the conversion, and you're still far enough from required minimum distributions to let the Roth account grow. Withdrawing from a traditional IRA before age 70 can also be a way to delay claiming Social Security. For every year you wait past your full retirement age, up to age 70, your benefit may increase by approximately 8% per year. Using IRA funds as a bridge while you delay is a strategy worth understanding and discussing with your financial services professional. If anything I've covered so far has raised questions about your own situation, give us a call at 866-973-3627 or visit manwealth.com. Scheduling a consultation only takes a few minutes, and we're always happy to work around your schedule. Now, regardless of whether you withdraw early or wait, everyone with a traditional IRA is required to begin taking required minimum distributions, or RMDs, at age 73. The money in a traditional IRA has never been taxed, and the government doesn't allow that to continue indefinitely. Missing an RMD can result in a penalty equal to 25% of the required distribution amount. The RMD is calculated each year based on your account balance and a life expectancy factor from IRS tables, so the more money in the account, the larger the required withdrawal. That's one reason why making strategic withdrawals or Roth conversions in the years before age 73 can reduce what the IRS requires you to take out later. For those who are charitably inclined and at least 70 wanted to, there's a valuable tool called a Qualified Charitable Distribution, or QCD. That's when you direct money from your IRA straight to a qualified charity up to $100,000 per year. The money bypasses you entirely, which means it may not count as taxable income, and it can satisfy your RMD requirement for the year. For people who are already planning to donate, it's a cleaner and potentially more tax-efficient way to give. Two more things that catch people off guard. IRA withdrawals can affect both your Medicare premiums and your Social Security taxes. On the Medicare side, if your modified adjusted gross income crosses certain thresholds, your Part B premiums go up through what's called IRMAA, or the income-related monthly adjustment amount. In 2026, those thresholds start at $109,000 for individuals and $218,000 for married couples filing jointly. Monthly premiums can range from the standard $202.90 up to $689.90, depending on income. And because Medicare looks back 2 years when setting your premium level, a larger than usual IRA withdrawal today could affect what you pay 2 years from now. It's one of those ripple effects that's easy to miss when you're only looking at the immediate tax bill. On the Social Security side, the IRS uses a figure called combined income, which is your adjusted gross income plus non-taxable interest plus half your Social Security benefits to determine how much of your benefit is taxable. Once combined income exceeds $25,000 for a single filer, up to 50% of Social Security benefits could be subject to income tax. Above $34,000, up to 85% could be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. These numbers haven't been updated for inflation in a long time, which means they capture more people than they once did. A large IRA withdrawal in a given year can push you over those thresholds without any change in your other income sources, which is another reason to think about withdrawal size and timing carefully. The thread running through all of this is that IRA withdrawal decisions don't happen in isolation. The size and timing of what you take out can affect your tax bracket, your Medicare costs, and how much of your Social Security is taxed, sometimes all at once. Looking at those interactions across multiple years, not just asking what you need in a given year, is where a financial services professional can be genuinely useful. Here's what I'd want every listener to take away today. The strategies that tend to work best are the ones planned in advance. The Roth conversion window, the pre-RMD drawdown strategy, delaying Social Security while using IRA funds as a bridge. The QCD option is for people with RMDs who are also charitably inclined. None of those are last-minute moves. They require a view of your income across multiple years, ideally before you're in the middle of a decision with a deadline attached to it. The traditional IRA is potentially one of the most powerful savings tools available, but managing the withdrawal side of it requires knowing the rules before you need them, not after. And it doesn't require having everything figured out perfectly. It just requires having the conversation. Sitting down with a financial services professional who can look at your full picture, including your accounts, your expected income sources, your Social Security timing, and your Medicare situation to help you think through the sequence of decisions ahead of you. That's a conversation I'm glad to have. If you have any questions about your retirement or your financial strategy, visit my website at M&A Wealth.com. or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure: all matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.